Value add. We've got George Dowd with us, director at the New Edge Group, live out of the CME in Chicago. Also from Las Vegas, Yu-Dee is back, principal and chief advisor at Ace Investment Strategists. Gents, good to see you. Thank you for your time. I'm trying to figure this out. We were just talking to John Chambers, the head of Cisco, minutes ago. He pretty much looked right through this whole European sovereign debt crisis. Then you hear from Sam Palmisano, and he's looking at doubling earnings by 2015. Why do you think, George, they're able to basically ignore, shrug off what's going on, which seems to have markets so rattled and look that far ahead?
I'm surprised. I'm actually surprised that they are. I think that in sort of the world that I operate in and the people that I talk to in the markets, I think they're still very concerned. And so it seems like Europe went all in with this package over the weekend. It remains to be seen, really how well it's going to work. Certainly the Greeks don't appear to be so happy with the fiscal austerity measures that they're going to have to take up, and the Germans don't really appear to be so happy with really having to contribute. And so for me, I think that while we had a little bit of resolution over the weekend, and certainly it bought some time, I don't think that everything's cleared up, and I wouldn't take continuing problems in Europe off the table at this point.
Let's get Yu-Dee in here for your snapshot on sentiment right now too, because there seems to be a large shift from the start of the week where many investors are saying you can't buy in this market and they wanted to have risk-free instruments. Do you think it is worthwhile dabbling in some equities right now because we had seen a fairly substantial pullback?
Yeah, I think so. Basically, I think the market is still in its uptrend. Don't forget, since the move that we had back in March of 2008, the market actually had about 7 pullbacks, and each time, minimally, it's about 4.5%, and maximally, it's about 9.5%. This time, we went through intraday-wise about a 10.5% correction, and of course, a lot of it is because of the bogus trading. Don't forget, the market does go up on wall of worries, and that's exactly what we're doing. So I think, of course, European debt crisis was a problem, is a concern, but if you look at the fundamental, basically the earnings of the company, it tells me that buying dips is still the way to go.
George, Bernie Lowe in Hong Kong here. How do you reconcile this renewed and, who knows how long it's going to last, but this renewed risk tolerance with where gold is going? I mean, people are still socking money away in what they perceive to be some sort of a haven, but they're willing to tiptoe back into the tulips, proverbially speaking here. How do you reconcile these opposite dynamics at play here?
I guess a couple comments. So, and gold. With gold, I think people like gold because it's not the euro. And so the Austrian Mint came out today. They said they've sold, I think it was 243,000 ounces in the last couple of weeks, which was just about the same or a little bit more than their entire first quarter total. Most of the buyers coming from Europe. And so I think you still have demand out of Europe. And, if you look at just the structural dynamics of the entire Eurozone and I guess de facto the European currency, the euro, you look at the debt to GDP criteria that were agreed at Maastricht, and 100% of the countries are above the 3% level there. And so I think there's the fundamental dynamics in place make you think that, look, we've addressed the Greek issue potentially, but that doesn't mean that we're not going to have problems down the road with Portugal, Spain, Ireland, maybe Italy. And so I think you're just seeing a lot of kind of safe haven flows into gold. And, surprisingly, gold's done so well with the dollar being relatively big. We saw that today and over the last few days where the dollar's having a fairly strong rally. And a lot of times you'll see gold come off on that. And that just hasn't been the case. Gold has really been, super strong, buying from all markets and all sectors. And you just haven't seen the effect from the dollar being so strong. And the strength is even greater if you look at gold denominated in other currencies.
George, I'm just curious, you folks over at the New Edge Group, you guys you do prime brokerage business. I was going to say you're the, fuel pump for hedge funds, but it's actually more like, you help to spark the afterburns by throwing raw fuel on it. This should be interesting. Give us a sense, who's asking for financing, funding, and leverage? What kinds of strategies? I mean, in the hedge fund universe, who's trying to make money out of this situation we're in right now, and how?
Right. Well, the customers that we talk to, my group in particular, we talk to a lot of the global macro funds and systematic funds, and in general, hedge funds are it's a total return product, and so they're not trying to beat any kind of benchmark. They're just trying to return, greater than zero. And so they're really just looking all over for different opportunities to make money. And where are they looking now? It sort of depends on who you talk to. I will say there's been a lot of commentary about, do equities remain bid, because of what's going on globally. But for me, the comments haven't been that people have really heightened prospects for kind of the fundamental economic reasons why you'd normally buy stocks, but more that this is a fairly significant liquidity event, and that liquidity is going to have to go somewhere, and more likely than not, you're going to see some of those flows into equity, so the equity market, could remain bid. And so a little bit of pessimism on the economic fundamental side of things, which normally you'd think people would look for stocks to go lower, but with a liquidity event like this, stocks and assets in general should remain bid.
Let me put the same question and follow up on Martin's query there with Yu-Dee here. Yu-Dee, a couple of years ago, you may remember the discretionary and the managed CTAs were all the rage, and then the bottom fell out. I mean, they were going negative when everything was going up, including ETFs. Is there, to add fuel to the fire argument here, is there too much kindling under any particular asset class right now, which might be setting us up for tears?
Well, I don't really think so. I think right now, over the short-term basis, basically, you were talking about gold a little bit earlier, even the technology sector. I think these two sectors basically are the heads you win and tail you also win kind of things. Because if the world financial crisis stabilizes, economy starts to grow again, then there's a possible worry of inflation down the road. Thus, you will buy precious metals. But if somehow the European debt crisis exacerbates because of the other PIGS nations go into trouble, in that case, you will still buy gold to hedge yourselves. When you talk about the technology sector, they're a very cash-rich sector, not prone to the credit issues. When the economy does recover, many companies have to replace their aging equipment, thus they have to turn to technology. If the economy does not recover because of the fact that they laid off so many people, they really have to get efficient, raise their productivity through technology, softwares, hardwares. Thus, the technology sector still goes well. I think to answer your question on the equity market, it's not an overall, in my opinion, an overall all-sector market. Thus, you can't just buy the broader market. You have to pick sectors to buy in this market environment.
Okay, gotta go. Yu-Dee Chang, don't work too hard in Vegas. Thank you, George Dowd. Thank you as well, Director, New Edge Group over at the CME.
Certainly looks sunny in Vegas there, Marty. Well, in the meantime,